what's happening in the precious metals market, what's happening in gold, what's happening in silver. Gold now trading above 4,300, silver now above $66. It's more than doubled on the year. I think these are signs that confidence is finally being lost globally in the dollar. The crash that I see coming and that I've seen coming for years is not a crash in the stock market. It's a crash in the dollar.
Just as gold and silver investors could be in the most significant phase of the cycle ever that could dictate returns even after 2026, one of the most potent precious metals has surged in decades. The US dollar has been on a bad run in 2025 and has been dropping in value by approximately 11% in the first half of the year alone. According to JP Morgan Asset Management, it was its worst performance over the period in the last 50 years. The dollar is also experiencing pressure because the Fed is increasing the number of liquidities in the financial system by starting to buy T-bills amounting to $40 billion a month, which became effective last Friday. Lastly, the dollar is also suffering as an outcome of fears that President Trump wants to install a dovish Fed chair, as it would be a bearish action to the dollar. Peter Schiff feels that what is happening in the precious metals market today is a big warning of a big red flag. The trading of gold and silver above $4,300 and $66 respectively, with silver exceeding it more than twice within a year, indicates that the world is losing trust in dollar. Although such loss of confidence has not been fully reflected in the bond market yet, Schiff believes that in itself is worrying. Before we start, make sure you subscribe and hit the bell icon to stay informed about our latest uploads.
I had expected a dollar crisis to happen a lot sooner, following the quantitative easing episode, but it didn't happen. And rather than, taking our medicine and trying to repair the damage that the Fed had done to the economy, we were able to do a lot more damage. The Fed got away with QE 1, 2, 3, even got away with the QE after the pandemic for a while anyway, before the effects really became evident on consumer prices. But I think now what's happening in the precious metals market, what's happening in gold, what's happening in silver, gold now trading above 4,300, silver now above $66. It's more than doubled on the year. I think these are signs that confidence is finally being lost globally in the dollar. You don't see it as much in the bond market, although, the long end of the yield curve hasn't done what a lot of people would have expected, despite all the rate cuts. We've had 2 rounds of now like 75 basis point rate cuts, yet the yield on the 10-year is still north of 4%, almost 4.2. I think it's going a lot higher, but the fact that it hasn't gone lower is a warning sign. But gold and silver are screaming that a currency crisis is coming. I think the foreign central banks have been out in front of this now for a year or two. They have been replacing dollars with gold. They've been, moving towards having real assets as reserve. Now, the gold reserves are now larger than U.S. Treasury reserves. A lot of that is not the result of the buying. I mean, some of it is from the buying, but most of it is from the appreciation in the value of their gold reserves. But that's going to continue. And I think they're going to step up the amount of buying. And I think other central banks that weren't buying gold, they're going to start buying gold. And I also think private investors that haven't been active are going to get active. In fact, Morgan Stanley, I guess their analyst came out a couple months ago and tweaked the 60-40 portfolio and said we should do 60-20-20 and, cutting the bond allocation in half in favor of gold. And that's basically a sell signal on bonds. And it's Morgan Stanley maybe coming to the realization that they're not really a safe haven, that the yields aren't high enough to offset what you lose to inflation. And so people need to hold gold. And that's going to be very problematic because we have, out of control deficit spending. And if foreign central banks aren't buying our debt and American investors aren't buying our debt, who's going to buy it? That really leaves the Fed as the last man standing.
Financial studies have remained in the spotlight that raises concerns on the long-term use of the U.S. dollar as the reserve currency with structural pressures of high debt and diversification by others. Large financial institutions such as Goldman Sachs estimate that gold can become as high as $4,900 by the end of 2026, partly because of central bank purchases and conditions of future Federal Reserve rates cuts. Central banks are choosing to accumulate gold and de-dollarize, which are also driving the prices higher, and other trends toward diversification. Schiff point out that this is a vicious circle. More people scramble to convert dollars into gold to prevent losing buying power, and this drives gold even further. This, according to Schiff, is the worst-case scenario. The value of what Americans own goes down, and the price of what they have to buy up. Now, let's focus on today's video.
And when you're seeing a big increase in the price of gold, it is indicating a loss of confidence in the dollar. That's why people are buying gold. And they're foregoing the interest that they could otherwise earn on U.S. Treasuries. So, no, I don't want to earn 4% on a Treasury. I'll hold gold and I'll earn nothing. And that says a lot, right? Because you don't believe that 4% is worth it, that it's not going to reward you enough to offset what you're risking by holding dollars or holding Treasuries. And as the price of gold goes higher and higher, that results in even more confidence being lost in the dollar. And it becomes a self-perpetuating spiral where more dollar holders want to convert them into gold, right? So that they can, stop the bleeding, what they're losing by holding dollars. And that's going to push up U.S. interest rates, because the only way that the U.S. can compete then with gold is by offering a higher rate of interest. Okay, 4% is not enough. What about 6%? How about 10%? But the problem is we can barely afford 4%, let alone 6, 8, or 10%. So we can't really pay our creditors a high enough interest to keep them lending because we can't afford it. The only rates that we can afford are rates that are so low that nobody wants to lend us the money. So the only lender becomes the Fed, because the Fed doesn't care about the return, and it just prints the money into existence and lends us that. But then, now you have runaway inflation or hyperinflation. So I think we're very close to the collapse of this system. And remember, the whole U.S. economy has been built on the dollar being the reserve currency. That's how we function. Trump doesn't understand this. He thinks the world is screwing us over, but it's actually the other way around. We've been screwing the world over, getting all their stuff for free. But they produce all the stuff that we consume, most of it, and then they lend us the money to buy it. And, they invest the profits in our bond market and our stock market. So they keep consumer prices down, asset prices up. We think we're rich. We can borrow against those asset prices. And then we get all this stuff. We didn't need factories. We didn't need pollution. We didn't need the workers. We didn't need the raw materials. We just created the money out of thin air. And we got all this stuff from the rest of the world. And when we get this dollar crisis, that all stops, right? The ride on the global gravy train is over. We can't import all this stuff anymore unless we export. And we don't have the capacity to export enough to cover our imports. So a lot of products that we used to be able to have won't be affordable to most Americans anymore. And if foreigners aren't selling us goods and they don't earn dollars, they don't need to buy our bonds, they don't need to buy our stocks. And so the price of goods goes up because we don't have as many goods, but the price of stocks really go down, or bonds, because we don't have all the foreign buyers. So, it's the worst situation where the value of what you own goes way down, but the cost of everything you need to buy goes way up.
The policy is not yet easy, even when the Fed has reduced interest rates to 4.5% down to 4%. Once inflation is included, the real interest rates are high, that is, financial conditions are still constraining. The fact that it is under constant pressure is one of the reasons why gold remains shiny. With the prospects of 2026, gold will perform better than the U.S. bonds and dollar, and one of the largest banks is going to maintain a maximum level of investment in the metal. To the investors, their message is simple. Pullbacks are to be used as buying opportunities, since the long-term trend of gold is in no way to be changed. Do you trust the dollar long-term, or do you see gold as better protection against inflation? Feel free to share your views in the comments. If this video was helpful, leave a like and subscribe to stay connected. We appreciate you being here.